if you miss an assignment date, don't think, oh, yeah, I can't turn it in. You can turn anything in all the way up through the end of the semester. And you won't get penalized. But again, it won't be in your grade until you do that. And I would encourage people to keep on top of it, not to wait till, week 16 and then try to make everything up. But it sound terrible, but don't not turn something in because you think it's going to get penalized. It won't.
I have a question. I know I remember that the syllabus said like I can't remember what it said. It said what was it? Like you can turn in work again.
Yeah.
What is that one? Can you go over that? Is that for only like homework or? Yeah,
it's basically for homework. The exams you can't turn those back in. The only way you can turn the exam, there's if there's a issue with submitting the exam. Then for instance, I've had people that have done the exam, and for whatever reason, it's saved as blank, so they've turned in blank exams, and those obviously you can resubmit. But there's no penalty for turning it in late.
Okay, that's good.
But yeah, the homework, and sometimes in the homework, part of the reason for doing that is if you do miss a date, it goes into 0, you can turn it in and you get the grade. But I've also had students that have turned in the wrong handout and things like that, and they say, oh, can you? And if you do turn in the wrong thing in the wrong assignment, you don't have to contact me to reset it. You can just turn it in again. I take the last one generally, unless something crazy happens. I take the last assignment you turn in. So if you turn in, oh, I turned in the wrong sampling exam instead of the sampling overview, I turned in something else. Just turn it in again. It's unlimited, the amount of submittals you can have. And I take the highest grade. So.
I'm sorry, you're saying I can turn in the exam late too, and I won't get penalized?
You won't get penalized. Your grade's going to look bad until it happens. But
well,
yes.
I'm going to be gone this weekend, and I'll be back on the 3rd.
Yeah.
I mean, I have it done pretty much. I just have to review to make sure I answer all the last questions. But just in case I don't have service, you know what I mean? Because I'll be in Mexico.
Absolutely, and again, if you can turn it in late, like say it won't be in your grade to date until you do, but you can turn things in late. Yes, I will take them. The objectives of the quarter are the objectives of the quarter. So if you meet those objectives, that's it.
Thank you.
Yeah, so and that goes for everybody too. And again, you don't have to rush and turn something in if you need another day to work on it or something like that. Take another day to work on it and get it the way you want before you turn it in. So, but yeah, I do take stuff late. And now, and I'll say one more thing, and then I'll shut up about it. I'd like to talk about some of the exam stuff, but I can't really talk about that if people haven't turned it in. So while there is no grade-wise pressure to turn it in maybe on time, there's a social one, and there's some things I like to talk about. There's part of the chapter 10 and 11 exam that I like to go over, and some people need to turn that in still. So there's some subtleties in it that I like to go over. But anyway, yeah, so that's it. Okay. That's my long-winded short answer. Okay, today, hopefully, we're going to finish up chapter 19, and I think I'm going to hold off on the exam because we got the sampling exam is due Friday, and the sampling exam is probably the most tedious of all of them. There's a lot in it. So I think I'm going to hold off on sending out the chapter 19 exam until next week. But I do want to see if we can finish it and maybe get to multiple choice, but we'll see how far we get. Okay, so having said that, let's jump into the chapter 19 exam. And just to kind of reiterate the Chapter 19 exam stuff. We talked about covered members, and that covered members are people that we held to a higher standard. They're usually people that can influence the audit. They're people who can influence the outcome of the audit. So, the audit engagement team, anyone who's on the audit itself, they can obviously influence the audit. And again, these are the levels that the AICPA came up with. And they stick to these levels so much, and they say, okay, if your organization isn't organized this way, everybody has to fit into these 4 categories: partner, manager, senior, associate. So you say, well, we don't use those terms. Well, whatever terms you use, you got to fit them into these 4 categories. So the audit engagement team, so these are kind of the main ones that you talk about, the audit engagement team. The people that work on the audit and the other partners in the audit firm. Some of these partners may be reviewing the work of the audit. So anyone who's a partner in the audit firm needs to also be held to this higher standard. And so that's in the audit engagement office. In other words, the office that they actually do the audit in. Now, the consulting office. If you're a consulting office, these are, it's only the partner and manager that are held to this higher level. So a partner and manager in the non-attest, so this is consulting. These are often called 10-hour people. Kind of an odd term, but the 10-hour people sounds like a Halloween movie. The 10-hour people. The 10-hour people are people that they have to do at least 10 hours worth of work to be considered a consulting partner or manager. If they haven't done 10 hours of work, they're not a covered member. If they've done 10 hours or more, they're a covered member. And those are, you know, again, those are people that need to be held to a higher level of independence. And we talked about this. These are kind of like mop-up kind of areas. The interesting one there is this, that the CPA firm itself is considered a covered member. The CPA firm itself cannot be invested in can't be invested in the client. And you remember that these are the main rules for this. Direct financial interests are a no-no. Indirect financial interests are okay if they are immaterial. So you can't have a direct financial interest, even if it's 1 share of stock, 1 bond. Can't have it. Indirect are allowed if they are immaterial. And they're usually through mutual funds or something like that. And we talked about those. We talked about immediate family members, and this is kind of leading into what I'm going to talk about today to start out with. And these are the people that you'll see when you go home from work. Spouses, spousal equivalents, could be boyfriends or, you know, whatever they are, whatever your arrangements are. Then, and dependent children that are in the house that are dependent on you. These are basically the people you see when you go home. Those are the immediate family members. And they are considered covered members. So they're considered extensions of the covered member, whoever the covered member is. So if you were going to audit, you know, and your husband owns stock and whatever, that is the same as the covered member owning stock. So these are people that are held. These are people that are immediate family members of the covered member, and they are considered covered members also. We stopped. Okay. Well, the question becomes, well, okay, well, there are some people that aren't immediate family, and you know, you have relatives and friends. We all know what friends are, so I'm not going to go into friends. But the question is relatives. What relatives are we talking about? Okay, well, relatives we're talking about are non-dependent children. So you have a child that is not a dependent. That is not part of your immediate family. They are considered to be close relatives. Your parents, siblings. These are all considered to be close relatives. Okay, now the financial interest. What are the rules for it? And these get kind of strange. They can have a direct they can have a direct financial interest if it is immaterial. And we're talking about immaterial to the person in question. So if it's your sister has a direct financial interest in IBM, is that interest immaterial to your sister? That's kind of the threshold we're talking about. And this is the kind of weird one. Direct financial interest, if it is material, but unknown to the covered member. So close relatives and friends, they can have direct financial interest as long as it's immaterial. Notice that this is less than the immediate family. Immediate family, nothing. But non-dependent children, parents and siblings, these are, and friends, obviously. They can have a direct financial interest if it is immaterial. So if your sister has an investment in IBM, but it's not material to her, that's fine. Now, this is the weird one. They can have a direct financial interest if it is material, but unknown to the covered member. So, you know, and just the way things are, sometimes you have family members that haven't spoken to each other in 20 years. You know, I have a sister who has a material investment in IBM, but I haven't spoken to her in 20 years. I don't know what she has or, you know, what she's invested in or anything else. So this unknown to the covered member is kind of an important one. So can close relatives and friends have direct financial interests that are material? Yes. If it's unknown to the covered member, if you don't know about it. And you know, and the point being to that is that you may very well not know about it. Right? So, you know, that's kind of the reasoning behind it. Okay. So let's go through some cases. Wanda is a member of the audit engagement for IBM. She does not own any shares of IBM stock, but knows that her sister owns 500 shares. The IBM stock is immaterial to her sister. Okay, is Wanda a covered member? Yep.
Yep.
She's on the audit engagement team. Is the interest direct or indirect? It's direct.
Alright.
Sister owns 500 shares of stock, so it is direct. And it is immaterial to her sister. So is Wanda in violation of the independence rules?
No.
No. Immaterial. It's a direct interest, but it's immaterial. She is not in violation. Stacy is a member of the audit engagement team for IBM. She's not only stock, but her knows that her brother owns 300 shares. Okay, so she's a member of the audit engagement team. So she is a covered member. The interest is direct. The investment is material to her brother. Is Stacy in violation of the independence rules?
Yes.
Yep, material. And notice that it very well could be that, you know, we're not talking about an amount. When we talk about materiality, it's what that amount means to, you know, whoever the close relative or friend is. So it's material to them. The idea being, again, that they could have some kind of an influence over. And again, here, you know, that she knows about it. Stacy knows about her brother's investment. By the way, there's just a myriad of amounts of things. When I was taking the CPA exam, they had you could send in, and the ACCT433 would answer whether these violate independence rules. And when I was going through that, I think they had something like 400, because there's all kinds of ones that, you know, for instance, if you had, let's say you had a second cousin, is a second cousin considered a close family member? Generally speaking, probably not. But you never know. You know, maybe a second cousin, maybe, you know, you raise a child, you know, as your own child in your own house, you know. So there's always, you know, gray areas and different things that could come up for these independence rules. But anyway, when I was going through it, it kept growing. It grew to such an extent that they just stopped doing it. They stopped publishing it. But when I was going through, I think they were up to 400 and some, you know, and you could go through and kind of try to figure out which case yours is similar to what they have, you know. Okay, Lawrence is a member of the audit engagement. Okay, well, Lawrence is then a covered member. he does not own shares of IBM stock, but his father has a material investment in IBM stock. Direct interest. Lawrence does not know about his father's investment. Is Lawrence in violation of the rules?
Nope.
Nope. And again, that's that kind of weird one that if they don't, the idea being if you don't know about it, it's not going to influence you. I just did something stupid there. Okay. Gravity experiments here, and gravity is just fine in this part of the basement. Okay. So, you know, and you look at these, you go, okay, wait, covered member, direct interest, material. One's yes, one's no. It has to do with this, does not know. The legal term for that is scienter, that knowledge. If you don't have knowledge of it, you know, you can't be held responsible for it. May is a member of the audit engagement team for IBM. So May is a covered member. Her mother owns an investment in IBM stock. May knows about the investment and asks her mother to sell it. Her mother refuses to sell the stock. Give me some room here. Is May in violation of the rules?
Yes.
Yep. I know that this one there's been court cases on this type of a rule. I don't know how the outcome has been, but I know there are people who have sued saying, look, I have no control over this. And, you know, I mean, people have a right to make a living. They say, look, I have no control over this. And, you know, it really doesn't have anything to do with me. And I have a right to make a living. You know, they're holding me responsible for somebody else in my family. So I do know there have been court cases about this in particular, this rule, but yeah, it's, generally speaking, they are not independent. Now they can do another audit. It isn't like they can't do any audits, but you know, if it's a material amount and it's known, then they're in violation. And that's kind of, you know, one of the more difficult things about this friends and family thing. The immediate family, you can figure, okay, you know, you can kind of, I don't say control other people in the family, but you can kind of say, look, you know, I need the job and you probably want me to have the job so we can, you know, sell the stock. But when you get to close relatives and friends, it's a little more difficult. Okay. Employment interests. This is when, well, there's actually two. Oh, maybe we get these over here. No, stop the video. There are two ways that you could have employment issue problems. You could have someone going from, let's see here. So for instance, let's say it's IBM. You could have someone going from the client to, that's the person, by the way, going from the client to the CPA firm. This is rare. Doesn't happen very often. I mean, does it happen sometimes? Yeah, it could, but this would be probably a fairly rare occurrence. Much more common is going from the CPA firm to the client. So one is they go from the client to the CPA firm. And again, this is rare. And this is common, happens all the time. So going from the client to the CPA firm, going from the CPA firm to the client. So there could be conflicts of interest here. You can see that if you're going from IBM to the CPA firm or this way, that there could be problems. So that's kind of what we're talking about for these employment interests. Okay, so client, employee gets hired. By a CPA firm, uncommon. The former employee cannot work on an audit includes the former employee's work. In other words, they can't audit their own work. So the question becomes, it really depends on what the employees, what their previous job was, as to whether they can work on the audit. Okay, let's say case. Gracie worked for IBM in the accounting department. She was recently laid off from her position. Gracie took a job with IBM's auditors. Can Gracie participate in the IBM audit?
No.
Nope. No, because she could be auditing her own work. Now, from a practical standpoint, you say, well, Gracie probably knows more about IBM and the accounting than anyone in the CPA firm. If she was there for every day for years or whatever, obviously, but the problem is she wouldn't be independent when she's looking at work. Now, a couple of years go by, her work is no longer included in the audit. Yeah. If none of her work is included in the audit anymore, she can work on the audit. But she cannot audit her own work. And so anything, if anything she did had, was included in the financial statements, which you would assume it would be, she can't do it. Okay, now for the wacky ones, and this is the very common one. I think I talked about this before. I'm not sure if I did though. it's very common to have, if somebody is, it's either up or out in a CPA firm. And it's very common for them to try to get their former auditors, you know, so if you work for Deloitte and Touche, whoever it is, when they decide that you can't be moved up, they'll try to get you a job in one of the clients. And usually it's great for you get out of the CPA firm, you don't want to work the 1,000,000 hours a week and all that kind of stuff. And so, you know, generally speaking, it's a good deal for the former auditor. So moving to from a client, from a CPA firm to a client. So we're talking about this. Ooh, I need to stop the video. Hold on, wrong thing. We're talking about this down here. Going from the CPA from the client happens every day. And so what are the rules for it? Well, here are the rules. Oops, oops, oops. So if they've taken the client's offer, oops, wrong or are still considering the offer, they must be removed from the audit. I should probably say accepted here. It's better. Oops, probably don't need to capitalize that. So if they've accepted the offer, or are still considering the offer, they must be removed from the audit. So now, if they have rejected the offer, there's no problem. So, you know, they said, okay, you know, we got a place for you at IBM, which, by the way, if you may want to consider taking that because that's in the, if they've already set this up, it's probably, you know, unless you have someplace else to go that you want to work. But if you refuse the offer, there's no problem. But if you accepted the offer, or if you're still considering, gee, I might take the offer, you have to be taken off the audit. So this is for a non-issuer. This is for ones that do not issue stock, privately held. Issuers. They still must follow the same rule here. These are usually state laws, state, you know, independent rules. Oops. So they still must follow the same rules as, you know, the non-issuer. This is looking like a mess here, isn't it? But they also have one more hurdle to jump through. Okay. And this is a kind of long-winded, but I'll talk. If a prospective client is in a key financial position, the prospective position is for a key financial position. This is important wording. Then they must be off for an entire audit cycle. And this entire audit cycle means that if you were on the audit in January of 2021, and they have this position they want you to take at IBM, it's a key financial position, and financial is important now. It didn't used to be, it used to be any key position, but now they narrowed it down to key financial position. Let's say that you're employed in January of 2021. You can't take it. You haven't been off the audit for an entire audit cycle, which is 1 year. You have to be off for the entire audit cycle of 2022. You couldn't take the position until January 1st of 2023. So even though it's 1 year, they call it the 1 year rule. It can actually be for more than 1 year. It can stretch out into almost 2 years. So you have to be off it for an entire audit cycle. And this is the interesting, and first of all, I'm surprised that this hasn't been challenged in court. It's still in effect, from what I can understand. The rule puts the onus on the company, not on the individual auditor. Technically, an individual auditor could walk into a key position, but the company is prohibited by the SEC of hiring somebody who has not been off the audit for an entire audit cycle into a key financial position. So, and again, it's kind of surprising this has been overturned, because a lot of times stuff like this does get overturned, but this hasn't, to my knowledge, it hasn't been overturned. So, what this means is, now, if it's not a key financial position, you can take it. But if it's a key financial position, you must be off it for entire audit cycle. You might wonder why they did this. This is why they would do that. It was fairly common for, especially higher ups people, usually like in the management position, like a manager level, that if, say, IBM needed a new controller, a new head of accounting, they would look to the manager. If the manager wanted to not be a partner, they look to the manager and say, okay, well, I'll put the manager in as the controller of IBM. Now think about that for a minute. The dynamic of that would be all these auditors that used to work for this manager, whose manager may have trained them all. That's who's going to be sitting across the desk during the audit for for these auditors that have come up after. So that's why a complete audit cycle has to have passed, so that you don't have somebody who's looking across at their former manager, who they may be looking for in the future for a reference and whatever else, that's not happening. At least not in the immediate time frame. It'll be for at least a year, possibly almost 2 years. So, and that was a problem, and that was a very common thing to have happen, by the way. That was very common. If a manager couldn't make partner, a lot of times they become controller of one of the clients. So that has kind of been eliminated for the publicly traded companies. If it's not publicly traded, if it's a non-issuer, it's privately held, you can take a key financial position. So this is only for publicly traded companies. They're regulated by the SEC. The companies themselves cannot hire the person. Okay. Okay, this is for an issuer. Sam is a member of the IBM engagement team. He's offered a job at IBM. Sam has not accepted or rejected the offer. Can Sam work on the audit?
No.
Nope. No, if they are still considering it. Okay. 13, George is a member of IBM's audit engagement team. He recently got a job offer from IBM. The job is for a staff accountant. Can George immediately accept the IBM offer?
Yes.
Yeah. A staff position is probably not someone who's has a tremendous amount of influence over it. Yes, it's not a key financial position. Lisa is a member of the IBM engagement team. She recently got a job offer from IBM. The job is for the controller position. Can she immediately accept the job offer?
No.
Yeah, this is one of the weird ones. The answer that we're looking for is no, and that's when you take the CPA exam. Truthfully, she could accept it because the onus is actually on the client. Now, the client would be told to get rid of her because you can't have somebody in a key position. She would not be able to take the job. But yeah, so this is a key financial position. The controller is the top accounting person, so that would be a no. Non-issuer. A member of the Geo Corp audit team. Geo Corp is a privately held company. She recently got a job offer for chief financial officer. Can she take the job? What do you think?
No.
Yes.
Yes.
Yeah, because this is that if it's a non-issuer, you don't have that. The key position rule. This key position rule does not apply to non-issuers. And quite honestly, a lot of times non-issuers are smaller companies. A lot of times someone coming from a CPA firm will come in as a key position. There's no reason for them not to go, to go in as a key position. So, yeah, if it is a non-issuer, there's no rules on it. There's no rules against taking the job. So issuer, non-issuer makes a big deal in this kind of employment. But non-issuer, yeah, you can take a key financial position. Okay. I'll push through these and then we'll push through this page, page 6, and then we'll. This one's kind of same idea. It's similar. Employment interest of family members and close relatives. This is kind of the same thing as the close friends and relatives thing. And that is that they cannot have a key financial position with the client. All right. Oops. Okay, so again, we're looking for key financial positions. So, and again, this is for family members and close relatives, but it could also be for friends too. They usually don't ask too much about friends because, you know, it's kind of a vague term. Okay, Sam is a member of the UPI audit engagement team. Sam's mother is the chief financial officer of one. Is Sam in violation of the rules?
Yes.
Chief financial officer, again, this is for family members and close relatives, so the mother is a close relative. And it is a key position, so yeah, so Sam is not independent when it comes to the audit. Mary is a member of the UP2 audit engagement team. Mary's father is the director of design at UP2. Is Mary in violation of the rules?
No.
No. Good. She is not in violation of the rules because it's not a key financial position. While it's a key position, it's not a key financial position. And again, this is somewhat new. This is you know, they kind of rethought this idea of key position because there are people that have nothing to do with the financial statements. You know, director of design probably doesn't do anything with the financial statements. So the new rule, the new kind of whatever rulings or workarounds or whatever you want to call it for this are that it has to be a key financial position. There has to be somebody who can influence the financial statements. If they can't influence the financial statements, we don't care. Okay. Now, there are independent and financial interests of non-covered members. And non-covered members are non-covered CPA firm partners and professional staff. Okay, this is for everyone else in the CPA firm pretty much. So these are rules that apply to, going back here, you know, you say, okay, well, what rules do apply to this senior, right? I mean, they're not a covered member, but does that mean they can just do anything they want? You know, and the answer is no. There are rules that apply to these non-covered members. Now, they're much more lax than the rules that covered members have, but there are rules nonetheless. Okay, so financial interest. They may not own more than 5% of the stock of the client. So it isn't that they, you know, it isn't that, no, you know, a non-covered member could own, you know, a huge amount. If it goes more than 5% of the client, then the whole CPA firm is not independent. So if one of these people owns more than 5%, now publicly traded companies is probably not that likely. If someone owned 5% of IBM, they'd probably be living on a private island somewhere. So, for publicly traded companies, this rule probably doesn't come into effect that much. But it can for smaller firms. And you may have someone working in a town that maybe, they work for the CPA firm, but maybe their family runs, they have 10 grocery stores in the area and they own 10% of it. Even though they don't work in it, maybe they own 10% of it. And so it is, for the smaller companies, it can be a problem that you could have family businesses. They get audited, and yet someone on the audit in the CPA firm could have a more than 5% interest in it. And if they do, the entire firm is not independent. Okay. Employment interest. May not be in an upper management position. That one's probably pretty obvious. But they also cannot be a director of the client. So they can't be on the board of directors. And by the way, sometimes, people get asked, you get to a certain level in business, they'll get ask you to be on a board of directors. A lot of times it's, not for bad reasons, it could be for good ones. But anyway. Okay, James is a senior auditor for a CPA firm that audits IBM. However, James is not a covered member for the audit engagement of IBM. James is also an ordained minister and recently set the position at the IBM board of directors as a spiritual director. James is not on the audit committee at IBM. Will James' position impact the CPA firm's independence? Yes or no?
No.
Yes. Even though it might be for all the right reasons, the entire CPA firm is not independent. You cannot be a director for whatever reason. And again, and they're pretty strict about, for any period that it is under the audit. So the entire audit firm would not be independent. Okay, I think let's stop there and we'll take a break and come back and clean up some of the wacky issues here. By the way, the stuff that we're covering this chapter, I know it's kind of tedious and this, but not that, and all this kind of stuff. This is about 20% of the current CPA exam, anyways. This is about 20% of it. They really get serious about this. Okay, be back at 7:03. How about 7:10? I guess I don't need to put PM there. It's going to come back at 7:10 in the morning and wonder where we're at. Okay, so we're going to take a break and finish this up. Let's see how much is left. Okay, new game plan. Hopefully we'll finish the handout. We are not going to do the CPA questions for it. I don't think we'll get there. All right. Okay, we'll go over the last part of this handout, and we'll put off the multiple choice stuff until next week. But this is kind of a cleanup thing, but they actually have quite a bit of, there's quite a few questions on these kinds of topics. Again, this independence thing, and ethics is a huge part of the CPA exam, like 20%. So, get used to seeing it. Something like these. It's like a mirror. Anyway, let's go ahead and share the screen. Past professional dues. This is when the client owes you money. Client has past due professional fees is considered to be an investment in the client. And here's why. You have a vested interest in the client continuing so that you can get your fees. So you are not independent. It's a past professional fee. So if your client hasn't paid you, you're not independent. I know it may sound odd, but so for instance, if they haven't paid you for the previous year, dues, I mean something significant, not a billing problem or something like that. But if they have unpaid professional fees, is considered to be an investment. Those unpaid fees are considered to be an investment in the client, and that you are no longer independent. So if they haven't paid them, they would have to get another CPA firm. Okay, gifts. I can't remember what pages these are on. Gifts, they should be clearly immaterial or appropriate in the circumstance. And I know that sounds kind of strange, but so clearly immaterial, if they give you some kind of a, cookies or something, you're not going to change an audit for cookies. So, unless they're really good cookies, maybe. But so anyway, clearly immaterial. Appropriate in the circumstances that there are some things, the one that comes to mind all the time is golfing. That some of these private golf courses, they may very well ask their auditors to come, in the client may have a golf outing and they invite the auditors to come. Some of those golf outings are very expensive. But it is a gift. It's appropriate in the circumstance and that everybody around is in the same, boat thing. But that's one of those things that is, can be difficult because those green fees might be $2,000 or something. So so appropriate in the circumstances is always kind of a tricky area. Litigation can come in basically three forms. Oops. Okay, so if the client sues a CPA firm, that could definitely have an impact on the independence, depending on if it's material or not. Auditor sues client, same thing. The one that's not as obvious, auditor's client A sues auditor's client B. Because in those cases, oftentimes you have to choose between which one. And obviously you're looking at, remember that you're looking at confidential information. A lot of the stuff that you look at for doing the audit is confidential. And if you have two clients that are suing each other, there's the danger that this information may impact the lawsuit and so forth. So if you have two clients that are suing each other, it could definitely have an impact on your independence. Okay. Consulting services. There's the threat that consulting services sometimes are more than the audit as far as billing. And so there is always this problem of consulting interfering with the audit. So you have to be very careful about what services you perform, that they will not the consulting services will not interfere with independence. I'll tell you the major one for that is the Enron case. In the Enron case, the consulting firm, the consulting arm of Arthur Andersen, called Accenture now, still around. They are the ones that made the joint ventures where they put all the losses. They had these joint ventures and then shifted all the losses into the joint ventures to get them off the books. The consulting firm set that up, the consulting arm of it. So when the auditors came in, they felt like they couldn't challenge them on these joint ventures because the company had, the consulting arm of the company had set those up. So that was obviously a pretty egregious conflict there. Reporting illegal acts. Did we talk about this already? I think we talked about it, reporting illegal acts, didn't we? Anyone?
No, I don't think so.
No? Reporting illegal acts. So this is when you have illegal acts by, you find illegal acts are being committed by the client. And it could be that they're illegal acts committed by the client. They could be illegal acts committed by members of management for the client. So there's all kinds of different ways that this could come about. Reporting illegal acts. If you come across an illegal act, and we're talking about material illegal acts. Parking your car in a handicap zone while it's illegal, and a terrible thing to do, is probably not going to be material. So we're really talking about things that are material here, not necessarily things that are trivial. Someone steals candy out of the candy machine. Well, that's, it's probably not anything that well, that is illegal. It's probably not going to impact the audit. But material illegal acts. You first notify management. and you'll evaluate their response. If the response is appropriate, do nothing. If it is inappropriate, for instance, they don't do anything about it. It depends.
Excuse me, do you mean do nothing or do nothing?
Oh, it's a good question. Yeah, so if it's appropriate, if they take care of it, they say, they notify whoever they need to notify and all that kind of stuff. You don't have to do anything else with it. If you think that their response is appropriate. So you notify management. You do not notify, say, the police or the FBI. You have a fiduciary duty to the client. Now, when you talk to the client, it may be that the appropriate action for them is to notify the FBI, right? So, I mean, it's not that it won't get reported, it's just that they will report it themselves. So if we find IBM is doing something terrible, the appropriate response might be that they contact the FBI. So if they do, if they don't contact the FBI and you think that that's appropriate, that they should, for instance, money laundering or something like that, then you have other options, which we'll talk about. If it's inappropriate, it depends if you are an issuer or a non-issuer. If the client is a non-issuer. Non-issuer, and I know this sounds like a cop-out, you got to get a lawyer. You cannot simply walk away from a client generally. And as a CPA, you also have a fiduciary duty, not only to the client, but to the public as a whole. So you are in a tough spot. If this is an inappropriate act or inappropriate response, here's a response here. You're in a tough situation because you have a fiduciary duty to the client, but you also have one to the public in general. As a CPA, you're similar to like a doctor or something along those lines. As a matter of fact, you get the CPA license, you're required to report, say, child abuse, elderly abuse. Those are things. We're held to a higher standard that we're there to protect the public also. So if you're not an issuer, you're going to have to get a lawyer, and the lawyer will guide you through what you need to do. It might be that you have to contact authorities, as far as what's authorities and that. It probably depends on what the illegal act is. Now, if you're an issuer, if your client's an issuer, within. Oops. Hey. if they're an issuer, issuers are regulated by the Securities and Exchange Commission. And if they have an inappropriate response, you have to contact the Securities and Exchange Commission within 24 hours. And the Securities and Exchange Commission will take care of it. So if it's a non-issuer, it's trickier because there's no cut and dry thing what to do. You have to get a lawyer and they'll see whatever the illegal act is and how to move forward with it. And can you withdraw from the audit? All that kind of stuff will come from the lawyer. If you are publicly traded, you have to contact the SEC, Securities and Exchange Commission, within 24 hours. And the idea being this, you use this kind of as leverage with the client. You know, IBM doesn't, you know, they should be contacting the FBI, you feel. They're not. You tell them, okay, look, in 24 hours, we're contacting the SEC. So maybe you want to rethink what you're doing. You know, the idea that hopefully this will get an appropriate response out of the client. So you have 24 hours. And if you don't answer in the 24 hours, you're going to be the one that's going to be, you know, the one that's in trouble, along with your client. You know, they're very specific on you have 24 hours to work it out. If you just not work it out in one day, then it, you know, you have to report it. Questions on that? So illegal acts, non-issuer, get a lawyer. Issuer, contact the SEC if it's an inappropriate response. Now, this is only if it's an inappropriate response. If they, you know, they contact the FBI, you don't have to do anything. You know, it's an appropriate response. You think they should contact the FBI, they do. Good. It's if they don't. So inappropriate response. By the way, the subpoenas thing is it actually, in some states, I think they're actually changing this. But right now, now these are valid subpoenas. With lesser requests. For example, you have a lawyer that wants this information, and maybe it's a lawsuit or something like that. The lawyer wants this information. A lawyer's letter doesn't mean anything. You know, if they deserve the information, they go to court, they get a valid subpoena, and then you can comply with. You gotta remember, you know, there's still this confidentiality that you have with the client. You don't just give their information out to anybody. So it takes a valid subpoena. It takes someone has to go into court, convince the judge that they need this information, that they have a legal right to it. And then with a valid subpoena, you can comply with that. But other than that, you don't comply. Okay. Auditors uncover evidence that the publicly traded client is routinely violating Environmental Protection Agency laws. Then with the evidence, the upper management board of directors do not respond within 24 hours. Okay, so this is not that they have an inappropriate response, they don't respond at all for 24 hours. In this case, which of the following, what should the client do? In this scenario, the client should do which of the following. Wait a minute, this is, this is bad. I'm sorry, change client, CPA firm. Change this. Apologize for that. That's error on my part. In this scenario, the CPA firm should do which of the following.
Tend to SEC.
Yep. Yeah, in this case, turn over to the SEC. So you give them this thing and they didn't respond at all.
Yeah, but why do you have to report to SEC when it has nothing to do with, like, financials? It's just environmental. So why not the EPA?
Well, it could be there could be something with the financials in that they are, well, first of all, remember as a CPA, you also have a duty to protect the public. So there is that there also, but EPA laws can have an indirect impact on the financial statements. They could have fines and there could be a liability hanging out there for their violations of EPA stuff. But if they are doing something that violates the EPA, Environmental Protection Agency laws, the CPA firm finds out about it and gives it to, if they don't respond. So if they have an inappropriate response or they don't respond at all in 24 hours, it goes to the SEC. And again, usually, now this one down below here talks about something that's immaterial, but yeah, if they leave it serious enough, there is a level of, what is it? We talk about Environmental Protection Agency laws. It depends on how big it is. But anyway, a non-response is the same as an inappropriate response. And by the way, you got to let the client know, look, you have to do something and you get 24 hours because we have to report it. I'm sure they, unless they're complete knuckleheads, they would know that, but. And so, yeah, now, and there's something true though, in exactly what you just said though. And that is, one of the things that is true is that we do, when it comes to breaking the law, we do focus more on those things that have a direct impact rather than those that have an indirect. This would be an indirect impact. They broke the EPA laws. There may be a liability out there because of it. They may have fines and cleanup and whatever else it is. So there could be this liability associated with the EPA stuff as indirect. If it was, say, cheating on the taxes, well, the taxes are right on the financial statements. Right, I mean, on your income statement, you're going to have tax expense, so that's a direct impact. That would be more serious. That's absolutely true. But even things that have indirect, you may very well be in the situation where, depending on how severe it is, that they must be reported. Okay. The CEO of a public traded company with Lee Parks is illegally handicapped. I just talked about this. And this one obviously would be what? Probably not going to have an impact on the financial statements.
Yeah.
You know, and if there is any repercussions to it, it's going to be for whoever the CEO is. You know, they're the ones that are going to have to pay it. So if there's something that is illegal but immaterial, you're not required to do anything. And we always kind of look at that. And again, immaterial is a judgment call. What is material? What's not material? Okay, contingent fees. All right, contingent fees. When we say something is contingent, you know, it means it relies on something else. Right. So, you know, am I going to take an umbrella? When I go outside for a walk, am I going to take an umbrella? Well, it's contingent on, is it raining? Now, if it's raining, I'll take an umbrella. If it's not raining, I won't take it. So taking the umbrella is contingent on something else. When it comes to fees, you can run into problems with that. Because you could have someone say, you know, you want to do an audit for someone, and you say, okay, the audit's going to cost $80,000. And the client says, okay, I'll pay $80,000 for the audit. If you give me a clean audit, I'll tell you what, I'll give you an extra $20,000. I'll give you $100,000 if I get a clean audit. So it's contingent on them getting a clean audit, the extra $20,000. So the question is, when can you do those kind of things? When can you have a fee that is contingent on something else? And so that's what that's what this whole thing is about. You know, so contingent fees. Now, contingent fees themselves are not prohibited. Okay, they're prohibited for audits or attestations. An audit being obviously what we've been talking about this whole class. Attestations could be for reviews or some, you know, lesser thing where you actually attest to something. So the scenario I just gave you where they said we'll give you an extra $20,000 if we get a clean audit, you cannot do that. You can take the flat fee. You can always take a flat fee, but you cannot take a contingent fee when it comes to an audit or an attestation. Oops. B, tax returns. This is another odd one. You cannot do taxes on a contingent fee basis if you are a CPA. If you're not a CPA, they do it all the time. So for instance, someone says, okay, you know, I'll do your taxes and I'll take 20% of your refund. Right, you know, so whatever your taxes are, I'll take 20% of your refund. Okay. Well, that's contingent on what the refund is. So you can't do it. Now, do people who prepare tax returns do that? Yeah, they do it all the time. But they're not CPAs. For a CPA, doing tax returns on a contingent fee basis is a no-no. You can lose your license for it. So tax returns cannot be done on a contingent fee basis. Why? It could jeopardize your client in that you might put things out that are not allowed on their returns. And remember, whoever the client is signing it, they're the one that's on the hook for the taxes. So on a tax return, it could be that the client is on the hook. And you also owe, and I'll talk about this later, you also owe a duty to protect the public too, and that you don't file fraudulent taxes for somebody else. Okay, and C, this one's a little bit odd. For financial statements that are used to obtain financing, you cannot do that on a contingent fee basis. Yeah, so client asks you to make financial statements, and they say, oh, by the way, if we get the bank loan, we'll give you an extra $5,000 if we get a bank loan. These are called compilations, by the way. You take a client's data and put it together. So preparing financial statements that are used to obtain financing, compilations is the term we use for those. You cannot do those on a contingent fee basis. Now, these are the exceptions. So if you're not doing the audit, you can accept contingent fees. So if you're not doing an audit, if you're not doing their audit, they say, can you put in our accounting system? And if you get the accounting system in 2 weeks, we'll give you an extra $3,000 or whatever. Yeah, you can take that. These are the three that you cannot do. Question on that? So contingent fees it's not that they're always prohibited. They're not. You can take contingent fees for a number of things, but these three things you can't. What time is it? Next discreditable. I'm going to skip. Access credible are doing bad things. There are some lists of things you can't do access credible. I'm not going to really go into them, but they, for instance, not paying your taxes. I'll put something here, I guess. There's a few. These are probably the two that come to mind. Not paying your taxes, not cooperating with subsequent auditors. So another audit firm comes in and starts doing the audit. You don't want to talk with them. Referral fees. For audits, they're prohibited. Okay, so referral fees. If you're doing their audit, they say, gee, we want to get a different insurance company. What insurance company would you recommend? There might be an insurance company that sends me $50 for everyone I send over to. If we're doing the audit, I can't do that. I can't take a referral fee if I'm taking the audit, if I'm doing the audit. So referral fees are no-nos for audits. Now, if it's not an audit, I'm doing something else for them. I'm doing consulting for them. They say, we want to, we need an insurance company. I say, okay, there's this insurance company that, I work with. As long as you tell them, by the way, I get a referral fee of $50 for everyone I send over there. So as long as it's disclosed to the client, there's nothing wrong with it if it's not an audit, if it's not an attestation. So, yeah, so audits prohibited. Non-audits, as long as you disclose it, you're okay. And CPA is a tax advisor. Nope. Cannot knowingly file questionable tax returns. You have a duty to protect the public. Okay, so cannot knowingly file questionable tax returns. So someone comes to you and they say that, they have this business and it's, they have 6 warehouses and 300 people working for them, and and they're have all these crazy looking expenses and receipts, and shows that they lose money or something like that, when it's obvious that it's not happening. You have a duty not to file those questionable returns, and you can ask them for backup, and if they don't give it to you, you can withdraw from the engagement. So a CPA firm cannot knowingly file questionable tax returns. Again, we have this duty to the public. By the legal term for what we are is professionals. CPAs are we're like doctors, lawyers. Any number of people are included in those. So professionals are held to professional standards. And this is, these are standards that are not, the general public is not held to, by the way. Okay. Now, this is a little table about things that you can do if you are publicly traded versus things if you are not publicly traded. Publicly traded companies are held to a higher standard, and the CPA firms working for them are held to a higher standard. Most of these things that we list here are going to be no for Sarbanes-Oxley for publicly traded companies. And yes for AICP, not all of them, but most of them. Publicly traded companies. Can they do the bookkeeping? No. AICPA, yes. As long as somebody else approves putting the bookkeeping, the journal entries and all that into the system, you can do it. Financial or accounting system installation, no. Not publicly traded companies, yes. The reason you can't do that, by the way, this is something that CPA firms used to always do with publicly traded companies. If IBM needed a new accounting system, they went to their auditors and said, hey, we need a new accounting system. Can you put it in? They can't do this anymore. Why? Because they're going to be auditing their own system. You know, part of an audit is auditing the accounting system. You're auditing your own work. If it's not publicly traded, you can do it. Appraisals or valuations? No. And this one is kind of a maybe. Generally, no, unless there are clear guidelines. An appraisal or valuation, this could definitely be a management activity. So unless there are very clear guidelines into how you do the evaluation, you generally can't do it because you're going to be auditing those valuations. Internal audit function. No. Internal audit function for the client. If you're doing the audit, it's kind of up in the air. Generally speaking, you can do it as long as you don't make any management decisions. So you could make the reports, but management will have to act on those reports. So if you say there's a problem in your shipping department, you don't have the management authority to make any of those changes. Only management does. Management of human resource recommendations, no and no. Generally speaking, you cannot do, hiring is a management activity. And by the way, this is another one of those things that used to always be farmed out to the CPA firm. If a company needed a new CEO, they'd hire the CPA firm to go get it for them. There were absolutely companies before Sarbanes-Oxley that were run by the CPA firms, pretty much. The CEO and a number of the top management people would have all been there because the CPA firm said to put them in there. And you can imagine that's not the best thing for kind of regulators to do. Investment service recommendations, no. This one is yes, but only for, generally for allocations, what they would call, and that is allocating assets to, you know, how much did you have in the Standard & Poor's 500? How much did you have in the bond market? How much did you have in whatever, real estate or whatever it is? So as long as it is not specific, you can do it if it's not publicly traded. Legal services, not related to auditing. This was an odd one. It's yes and yes. And it's odd because there are no rules. There's no standard on legal services at all. So because there are no rules, there's no rules against it. Now you still have to be careful in that you're not violating other rules about independence. But there actually are no rules from the AICPA or from the PCAOB on doing legal consultation for non-auditing issues. Kind of a quirk. It's allowed because there's no rules. Planning common tax issues, yes and yes. Being unusual or aggressive tax issues, no and no. This is a very important rule. Auditors cannot be advocates for their clients. This is something that sometimes clients don't understand. If you do an audit, they get a clean audit, and they say, well, why don't you come into the bank with me when we give them these financial statements, and just to let them know that that we have an up and up business, and you give us clean audit on there, and you can't do that. You cannot advocate for the client at that point. You're not no longer independent. So auditors cannot advocate for the client. So when it comes to unusual or aggressive tax issues, they can't stand up and advocate for their client's position. If it's common tax issues, if it's run of the mill, pay 23%, whatever, that's fine. But for aggressive ones, where they have some unusual thing that they're trying to push for, that's a no-no. Individual tax services for officers, no. Yes. So those are kind of some of the rules that they have that are, of who can do what. And, generally speaking, as an auditor, you can't do any management for the client. And even when you do if you do something like a bookkeeping, you cannot approve the journal entries going into the system. Someone in the company has to do that. So you can do the bookkeeping, have someone do the bookkeeping and give it to them, but then somebody has to approve those before they get posted. Question on any of that? This one tends to be one that is asked quite frequently on the CPA exam for whatever reason. This used to be a very common thing. And financial accounting system installation is not allowed for publicly traded. It's allowed if it's not publicly traded, if they're using regular off-the-shelf software usually. But that's one that gets tested. The tax planning issue sometimes comes up. There's a funny one about this. When Sarbanes-Oxley came out, there was a company that had its officers had the CPA firm do their taxes, and the officers in the company, rather than replace the auditors, they fired the two officers in the company rather than getting rid of the CPA firm, and the SEC found out about it. So they take this very seriously. And it used to be when you go into when companies would do an audit, they would do the individual taxes for all upper management. If you're upper management, you got free taxes. Your taxes done free by one of the top CPA firms, and that was a real perk that they would give to all of the officers to keep the business, and that's no longer allowed. Okay. That's enough auditing for one night, isn't it? Maybe even a little too much. So next week we'll wrap this up. So the only thing that so to turn in is the sampling exam. That's the next thing up on the agenda. And then just know that I did put in these things that you can't see because I'm not sharing. We already did these things, but the sampling overview and the sampling practice exam I put in there also. That those two were my oversight, my whatever that I didn't pay attention to. So those are on there too. These are both due by the 5th of November. You've already got them done. We already did them in class. But okay, any questions? You guys are sound asleep, aren't you?
No, no question.
Well, you should be. This is as boring as I can get. I was hoping you guys would get a good night's sleep. All right, so we will go ahead and pick this up next week. So the sampling exam due Friday, and yeah, so you get that in. And again, if you are missing work, it's past due, you still can turn it in. So don't think that, oh, I missed it, I can't turn it in. You can, and you get full credit, but obviously I won't have a grade until I can see it. So any questions?
No, no question.
Okay, well, have a good evening, and I'll see you guys in a week's time.
Okay.